Lithium Americas Corp, a company with absolutely zero revenue staring down a massive construction bill, and yet its stock is trading, what, maybe 20, even 60% higher than the fundamental math says it should be. It seems way too expensive on paper.
And that gap, that premium, well, that's exactly what we're digging into today. We're looking at LAC, ticker LAC, trading around, say, $7.26 as of September 25th, 2025.
Right.
And the core tension in all the source material you sent us is really stark.
Yeah.
Is this valuation totally justified because the project is just that strategically important for the U.S.? Or is it, kind of a speculative bubble fueled by geopolitical hopes?
Yeah, that's the question. We've gone through all your sources, and we're jumping straight into this deep dive. Our goal here is simple. Give you, the listener, a fast, clear understanding of the bull case, which is all about national security, versus that stark bear case, which is really rooted in some serious development and operational risks. Let's unpack America's biggest known lithium deposit. Okay. First things first. Let's get grounded in Chapter 1, Business Understanding. The absolute crucial starting point is that LAC is pre-revenue, development stage. Its entire reason for being is building this one project, Thacker Pass, up in northern Nevada.
Right. And you have to understand, this isn't just any project. The asset itself is genuinely world-class. That's why the stakes are just so high here.
Okay.
The scale is, well, it's pretty staggering. Thacker Pass is the largest known lithium resource and reserve in the entire United States.
No.
And it's up there globally, too.
Wow.
They're looking at initial production, maybe late 2027. Phase 1 is aiming for 40,000 tons per year of battery-grade lithium carbonate.
And that's LCE, right? Lithium carbonate equivalent.
Exactly, LCE. That's the standard benchmark. Here's the thing. 40,000 tons is just the start, just phase 1. The potential over the mine's life, which they project to something like 85 years, it could eventually hit 160,000 tons a year.
85 years. That's incredible longevity.
It really provides a long-term view that's quite different from many other projects.
So that brings us to the strategic angle, the moat. Their main value proposition isn't just digging stuff up. It's about becoming the secure, reliable, large-scale domestic U.S. supplier, which, tackles that big vulnerability the U.S. has, relying on other countries, especially China, for processing critical minerals. This is really about supply chain security as much as mining.
And that strategic importance, well, it translates directly into some pretty unprecedented support, both corporate and governmental. First off, you've got General Motors.
A GM deal. Yep.
It's huge. A $945 million total investment commitment. And, critically, a binding offtake agreement for 20 years. They've locked in GM to buy 100% of Phase 1 production for 2 decades.
20 years. That basically guarantees your customer for Phase 1.
It de-risks that side of the equation massively. Then you have the U.S. government stepping in.
And this is where the valuation story gets really interesting, isn't it?
Absolutely. There is a conditional commitment from the Department of Energy for a $2.26 billion loan. That's billion with a B.
Wow.
It's through the ATVM program, the Advanced Technology Vehicles Manufacturing Loan Program. Usually that money goes to car manufacturers, Ford, Tesla.
Right, finished products.
Exactly. The fact that a resource developer like LAC is getting this loan just shows how central this specific mine is viewed in national policy terms. It's seen as critical infrastructure.
And then layer on top of that the recent, pretty dramatic news, the possibility that the Trump administration might seek a direct equity stake, maybe up to 10%.
Right, that potential move really elevates it. It's not just a private company getting a loan. It starts looking more like a public-private partnership focused on national security.
So all this is happening while the overall demand picture for lithium is just exploding, basically.
Oh yeah, the backdrop is a huge tailwind. Demand for EVs is driving this. Global lithium demand, measured in LCE, is forecast to basically double, from about 1.8 million tons in 2025 to maybe 3.7 million tons by 2030.
So even with lithium prices bouncing around recently.
Yeah, there's been volatility in the commodity price for sure, but the long-term trend, the structural demand from electrification, that looks undeniably strong. Exponential, really.
Okay, so locking up GM, securing billions from the DOE, that's massive strategic progress. But, deals are only as good as the team that can actually deliver, actually build this thing. What do the sources say about management? Let's move to Chapter 2, Management Evaluation.
Well, the CEO, Jonathan Evans, he comes with relevant experience. He previously ran the lithium division at FMC, which is now Livent, so he knows the space.
Okay, that's helpful.
But it's important to understand, management's biggest wins so far haven't been operational. They haven't built the mine yet. Their successes have been strategic and financial.
So things like getting the permits, closing that GM deal.
Exactly. Navigating the really complex multi-year permitting process was huge. Closing the GM joint venture, absolutely critical. Securing that massive DOE loan commitment. And also executing that complex corporate separation back in October 2023.
Right, they spun off the Argentinian assets.
To create this pure-play, U.S.-focused company. That move brought a lot of clarity for investors and, frankly, probably made the U.S. government support easier to secure. It really de-risked the financing side of things.
And you see that focus in how they're allocating capital.
Absolutely. 100%. Every available dollar is going towards that $2.93 billion Phase 1 construction cost for Thacker Pass.
That's a big number, $2.93 billion.
It is. And their strategy, leveraging that low-cost government debt alongside strategic equity like GM's, well, it's been much less dilutive to existing shareholders compared to how a typical junior miner might have to raise that kind of cash, selling shares over and over again.
Makes sense. So obviously no dividends or buybacks then.
No, not even close. Every cent is being plowed back into construction right now. That's the sole focus, building the asset that will hopefully generate future revenue.
Okay, let's get to the financials then. Chapter 3, financial analysis. The market cap is hovering around $1.75 billion, given zero revenue, massive spending ahead. How on earth do you put a fundamental value on this company right now?
Well, the current reality is exactly what you'd expect for a developer.
Yeah.
They're consistently unprofitable. Pre-revenue, I think the net loss in 2024 was around $42.6 million.
Right.
And looking ahead, free cash flow is going to be deeply negative for the next few years. We're talking maybe $2.5 billion flowing out between 2025 and 2028 just for construction.
But didn't you mention earlier their balance sheet looks okay right now? Good current ratio, low debt. That sounds odd if they're burning cash.
It does sound counterintuitive, but it's a snapshot in time. Right now, yeah, metrics like the current ratio, debt to equity, they look healthy, but that's because they're basically sitting on this temporary war chest from the recent capital they've raised, like from GM. That picture changes dramatically once they start drawing down that $2.26 billion DOE loan. That debt will hit the balance sheet, and their leverage profile will look very different once construction financing is fully tapped.
Got it. So comparing them to profitable companies doesn't work, which is why discounted cash flow, or DCF, is really the main tool here, right, to value this single, very long life project.
Exactly. DCF is tailor-made for this situation. You project the potential cash flows over the entire 85-year mine life, factor in costs, lithium prices, and then discount all that future money back to today's value using an appropriate discount rate.
And when you run those numbers, what does the DCF show?
Well, this is where the disconnect really shows up. Using pretty standard, arguably prudent industry assumptions, things like long-term lithium prices, maybe around $11,000 to $13,250 per ton, and fairly high discount rates, say 10–12% because of the execution risks.
Okay.
The estimated intrinsic value per share falls somewhere in the range of about $4.50 to $6.
$4.50 to $6, and the stock is trading today at $7.26.
Precisely. That's the core conflict right there. That gap, that premium above the $6 top end of the fundamental range, that's essentially the market pricing in this national security premium.
So the market is basically saying, we don't care about the traditional math right now. We're betting on flawless execution and strategic necessity.
That seems to be exactly what's happening.
Okay, that valuation gap makes LAC a real battleground stock, doesn't it? Let's look at how the market is reacting in Chapter 4, gauging the market's mood.
Yeah, it definitely is. And Wall Street analysts seem to agree with that fundamental valuation range we just discussed.
Their price targets are lower.
Much lower.
Yeah.
The average 12-month analyst target is right around $4.70 to $4.83. So basically slap bang in the middle of that DCF range.
Yeah.
The consensus rating is mostly hold or maybe moderate buy. A lot of analysts think this recent run-up in price has gone too far, too fast.
And TD Cowen actually downgraded them recently.
They did, just on September 25th, citing exactly the huge price appreciation, suggesting it's gotten ahead of itself.
And that huge appreciation, just to reiterate, was almost entirely driven by that news, or potential news, about the U.S. government maybe taking an equity stake, right? Framing it as a national security play.
Absolutely. That narrative became incredibly powerful in the media and among investors very quickly.
And adding fuel to that fire is the short interest situation.
Oh, yeah. It's high. About 13.4% of the public float, that's nearly 28 million shares, were sold short, according to your sources.
That's a significant number of people betting against the stock.
It is. And when you have that level of short interest combined with a powerful positive news catalyst, like the potential government investment, well, you get the classic setup for a potential short squeeze.
Explain that quickly.
Sure. If the price starts rising rapidly because of the news, those short sellers who borrowed shares to sell hoping the price would fall start losing money fast. To limit their losses, they're forced to buy back the shares they borrowed.
Which pushes the price up even more.
Exactly. Creates this feedback loop. Buyers rush in, forcing shorts to buy, which attracts more buyers, and the price can rocket upwards, sometimes really detached from any underlying fundamentals.
And you can see that extreme momentum in the technical charts, right?
Absolutely. That price of $7.26 is trading. Get this, 124% above its 50-day moving average. The average price over the last 50 days was only around $3.60.
Wow. That's an explosive move. Purely news-driven.
Completely detached from its recent trading pattern before this news hit.
Okay, so despite the analyst caution and the high price, who are the major players betting on this vision? Let's move to Chapter 5, ownership structure.
Well, the ownership structure is really anchored by one major strategic player, General Motors Holdings, LLC.
GM again?
Yes. They're the single largest shareholder, holding over 15 million shares. And their involvement, as we discussed, goes way beyond just being an investor.
Right. They're the guaranteed customer for 20 years.
Exactly. That makes their buy-in incredibly significant. You have to assume GM did enormous due diligence on the technical aspects of the project before committing not just capital, but also to buying all the output for 2 decades. It's a massive expert endorsement, really.
That's a great point. What about other institutions?
Institutional holdings are around 23.3%. What's interesting is that a good chunk of that often comes through thematic ETFs, funds focused on rare earths or the energy transition, like the VanEck RMX or Miro Asset LIT ETFs.
So ownership is linked to that bigger picture trend, not just LAC specifically.
In many cases, yes. Investors are buying the theme,
Yeah.
and LAC is a key holding within that theme.
Any insider activity worth noting? Management buying or selling?
It's modest, but it's positive. Over the last 12 months, insiders management directors have been net buyers. They've acquired roughly 366,000 more shares than they've sold. That's huge, but it suggests they have confidence in their own plan.
Okay, good sign. Now, let's shift gears to the really critical part, the potential roadblocks. Chapter 6, risk assessment. Let's use a SWOT framework, maybe. Strengths are pretty clear by now.
Right. The strengths are significant. Phase 1 is fully funded. Getting that nearly $3 billion in CapEx secured is a huge de-risking step. And that unparalleled strategic backing we keep mentioning, GM, the DOE, maybe even direct government equity, those are powerful advantages.
And the weaknesses.
The obvious ones are dependency on this single asset if Thacker Pass fails, the company fails, and the massive cash burn during construction. But the weakness that becomes a major risk is what your sources call novel technology risk.
Okay, explain that. This is about how they get the lithium out.
Exactly. They're planning to extract lithium from claystone using a specific metallurgical process, a flow sheet, that's different from the more established brand evaporation ponds or hard rock mining methods.
And this is the first time this specific process will be used at this massive commercial scale?
Correct. And that jump from a smaller pilot plant testing batches to a huge, continuous 24/7 industrial operation using complex chemistry that hasn't been proven at this scale before, that is notoriously difficult. It's often called the valley of death for resource projects.
Valley of death.
Yeah.
Sounds ominous.
Well, it can be if they can't consistently achieve the target lithium recovery rates, or if they can't meet the very high purity standards required for batteries at scale, day in and day out, then the whole economic model breaks down. Doesn't matter how great the contracts are if you can't deliver the product efficiently.
So that technical execution is arguably the single biggest internal risk.
I would say it's the most significant underlying risk, yes. Everything else hinges on them getting that right.
Okay, and then you have the external threats, the usual suspects.
Precisely. Commodity price swings are always a risk, although that long-term GM contract buffers phase 1 significantly. And then macroeconomic factors. Stubborn inflation could push that $2.93 billion construction budget even higher. Rising interest rates would make any future debt financing beyond the DOE loan more expensive.
Right. Standard project risks. But that technical piece sounds paramount.
It really is the make-or-break challenge, operationally speaking.
Okay, so let's try and pull all these threads together. We have these two really compelling, but almost completely opposite stories playing out. Let's synthesize this in Chapter 7, conclusion.
Okay, so the bull case is powerful and clear. You're investing alongside major players like GM and the U.S. government in a truly world-class lithium asset located securely within the United States. It's deemed critical for national security, and the biggest hurdle funding the initial construction has been largely overcome through very creative and supportive financing.
That sounds pretty compelling, but then the bear case.
The bear case is equally stark, grounded in financial fundamentals and operational reality. This is still a single project company, years from revenue, facing enormous execution risk, particularly on the technical side of actually producing the lithium at scale using a novel process. And critically, the current stock price, around $7.26, is already trading well above what traditional discounted cash flow models suggest it's worth, based on reasonable assumptions that $4.56 range.
So putting it all together for the listener.
I think the conclusion from your sources is that an investment in LAC right now at this price is undeniably a high-risk, high-reward proposition. That premium valuation isn't based on current reality. It's reflecting the immense strategic and geopolitical value placed on this project, and it's essentially baking in the assumption of near-flawless execution over the next, say, 3 to 5 years.
You're paying a premium today for the hope of perfect delivery on a project deemed a national priority, not necessarily for a mine that's guaranteed to be profitable based on today's numbers.
That's a very good way to put it. You're betting on the plan and the national importance more than the proven operational track record, because that track record doesn't exist yet.
Well, thank you. That really clarifies the opposing forces at play here. Thanks for letting us take this deep dive into your sources on Lithium Americas Corp today.
Absolutely. And before we wrap up, maybe one final thought for you, the listener, to chew on based on everything we've discussed. If that significant valuation premium we see today is almost entirely built on this strategic alignment with the U.S. government and its national security goals, how much of the very real operational and technical risk is actually being priced into the stock right now? And perhaps more importantly, what happens to that premium if political winds shift, if priorities change in Washington over the next few election cycles before Thacker Pass is even fully up and running?
That's a critical question, something definitely to ponder.
Okay, folks, like and subscribe to Stock Analytics AI. Remember, members paying €4.99 a month get priority deep dives on the tickers you request. And we are committed to covering all of the S&P 500 stocks over the next few months. Members get that exclusive priority access. If you just want a one-off deep dive on a stock you're interested in, drop us a super thanks on the video.
And the necessary disclaimer. This analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be taken as financial advice. Please, always conduct your own thorough research before making any investment decisions.